Good morning, traders. This is Tony D from easyMarkets in Sydney. You've seen another stellar little rally extension overnight. Risk appetite is on. We're getting closer and closer to this tax plan being approved by the US Congress. One of the holdouts there, one of the senators, Susan Collins, has agreed to support the bill. Looks like it'll be happening in the next couple of days. Trump probably signing it this year. They're calling it, the Christmas tax cut. In terms of how important and how good it is for the economy, that's a different story. Cutting tax rates for companies definitely will help the stock market rally. But this sort of rally that you'll get from the stock market doesn't always translate into economic growth and performance. Now, you're seeing this come through in weakness for the US dollar. Now, that weakness in the US dollar is by skepticism that this tax plan is going to flow through to the economy, and that the US growth is going to get back and hold above 3%. A little bit concerned there that the best has come for the US, as currently all priced in. What you're going to see next year is only room for disappointment. So, in terms of how far this US dollar can rally on the back of the same news again and again, very unlikely that the tax plan will now provide a huge boost for the US dollar short term. You may see a small rally, but nothing crazy, and definitely not against something like the euro. If you're going to see the big moves, it's going to come up against something like dollar yen, which is a little bit more receptive to risk on sort of moves with the stock market. So last night, though, with that skepticism, you did see the euro pop 118. It did fade back and hold below 118, so it's really comfortable in the 117 handle. You're seeing this pair really not like to break out of it. Every time we get out one way or the other, it's going back towards that 117.50 level. So that's just range trading, very gentle market at the moment. If you're looking at dollar yen, didn't really get back to the 113 level, so it's struggling now. Constrained between the 114 to 110 levels, but in terms of the next 100 pips, 200 pips, very hard to see it breaking out of that range. We won't see too much until early January, where we start to see if the economic growth is picking up, inflation is picking up. Really going to have to see inflation if you want to get the dollar yen to resume its uptrend, get back to those 115 to 120 handles. You're going to have to see some sort of inflation come through, which opens the door for the US raising rates quicker than currently expected. Market is not currently pricing in 3 rate hikes. Fed is, but we'll see exactly how that plays out next year. That's one of the big risks, one of the big one of the big risk factors for the whole of next year is how many times the Fed's going to raise rates. As it was this year, it turns out to be a pretty steady year for the Fed this year, but you have a new governor in town, so we'll see. Gold took advantage of the US dollar weakness to push back above 1260. Really surprising that gold is so well supported in the risk-on environment. Generally, when stocks are at record highs, you don't see too much support for gold. But gold is no longer at 1330. This number down here, 1240, where it tested, is quite low. We couldn't get back above the previous resistance though, which comes in around 1265. It's the previous support, which is now the resistance. So you're going to see gold struggle to get further here, especially if stocks are high, unless you get a US dollar negative story coming through from data. But the data story is a little light this week, so you are going to have to keep your eyes peeled for any sort of reaction to the tax plan, which could come out by Wednesday, Thursday. But in regards to gold, I wouldn't be chasing this nascent little rally at these levels. The commodity story is a little bit stronger at the moment. That's helping Aussie dollar be well supported. If you look at copper here, just quickly, it's been grinding high in a nice uptrend all of December. All right, so this is supporting Australian dollar. Aussie dollar is back at 76.50. If you're looking at the Aussie dollar and you're looking at the medium-term outlook of it, then you have to keep in the back of your mind when you are looking at the Aussie dollar. Just bring up the previous resistance, which is so important for the Aussie, is this 77 to 77.50 level. So we're sitting 40 pips underneath it. All of 2015, 2016, we were capped by that 77.50. Now we've had a brief run above it in the most of the middle of this year we were above 77.50, but we've broken back down below, and it's a natural level that the market's going to find resistance at. So this is a big level, and if you're going to be involved in Australian dollar, just be aware that the next 50 points is probably the best selling points in the market. If you're in this pair for the short side, so it has to really big levels to break past. So it's very hard to get really bullish here on the Aussie dollar, given that resistance, given the lack of catalyst, given the lack of RBA stance here. RBA is very, very neutral out there, so it's all about the US dollar side of the equation. Unless the commodity currency, so the commodities like copper were to continue to rally relentlessly, then you won't see the Aussie break back above 77.50 very easily at all. Alright traders, expect more range trading given that the US dollar is not following the stock market. We will see, focus, if you are on the stock market, do focus on what's going on at the 25,000 level on the Dow. That level is pretty key in terms of targets for most traders. Psychologically also quite a key level. It could be the target coming in the next couple of days for the US dollar, for the Christmas rally on the back of the tax cuts. Could easily hit that. We're in striking range now, only 180 points away. All right, we'll be back tomorrow. See an update. I see if there's any news over the tonight. Could start to looking for the relief rally to taper out or to fail, but at the moment there is no reason to buck that trend as well.